Hello, everybody. Welcome to another FinQuiz session where we'll be tackling the world of options, one of the most fascinating corners of the derivatives market and a hot topic for your CFA Level 1 exam. I'm here to make sure you fully grasp these concepts from basic definitions all the way to the nitty-gritty of replication strategies and option pricing quirks. As always, don't forget that FinQuiz's Stanley Notes, mock exams, and battle-ready summaries have helped thousands of candidates streamline their prep and build the confidence they need to pass. Let's jump right in. If you've ever wondered how investors manage risk or make big profits with small investments, options are one of the most powerful tools in the financial world. Now, before you get nervous, don't worry, we're going to break this down step by step using real-world business examples so that by the end of this lecture, you'll not only understand options pricing and valuation, but actually remember it. Think of options like a VIP pass to buy or sell something at a set price in the future. You're not forced to use it, but if it works in your favor, you can. And just like any VIP pass, it comes with a cost. This is what we call the premium. First up, let's talk about how options work at the very core. Picture this scenario. You decide you want the right, though not the obligation, to buy or sell an asset at some point in the future. To lock in that right, you pay a fee to the party giving you this flexibility. This fee is what we call the premium. The buyer of an option, that's you, pays the premium up front, which compensates the writer or seller of the option for taking on the risk. There are two basic flavors of options, calls and puts. A call option is your ticket to buy an underlying asset at a specific price on or before a certain date. A put option, on the other hand, gives you the right to sell that underlying asset in the same fashion. If you think the price of something, like a stock or a commodity, will go up, you'd be eyeing a call option. If you think it will go down, a put might be your best friend. Let's put this into a real-life context. Imagine you're a sneakerhead and you see a limited edition pair of Air Jordans that you know will skyrocket in price. But right now, you're not sure if you want to spend all that cash. So you make a deal with the store, pay them a small fee to lock in today's price, and give yourself the right to buy them in the future. That's a call option in action. If the price of the sneakers goes up, you win because you get them at a cheaper locked-in price. If the price doesn't change or drops, you just walk away. You only lose the fee you paid. Now let's flip the script. Say you own those sneakers and you're worried they might drop in value. You find someone willing to pay you a fee in exchange for the right to sell them at a fixed price later. If the price drops, you win because you can sell at a higher price than market value. That's a put option. Got it? Good. Now, let's dig deeper into what affects the value of these options. Now, unlike forward or futures contracts, options give you asymmetric payoffs. By asymmetric, I mean that if you're the buyer, your potential loss is limited to the premium you paid, but your upside could be significant if the underlying moves in your favor. This is why we sometimes call options contingent claims. Their value depends on whether the underlying price crosses a certain threshold. Three important measurements describe where an option stands. Exercise value, also called intrinsic value, basically measures what you'd gain if you exercise the option right now. Moneyness indicates whether an option is in the money, at the money, or out of the money. Time value is that extra kicker on top of the exercise value, reflecting the possibility that the underlying price could swing favorably before expiration. And of course, there's a difference in the style of exercise. There are two styles of options you'll see. European options only let you exercise at maturity, while American options let you jump in any time up to expiration. Having that flexibility can change an option's value. Imagine you're trading options on two different assets, the S&P 500 index and Tesla stock. Now, okay, if you buy an option on the S&P 500 index, it follows the European style, meaning you can only exercise it on the expiration date. Even if the index moves in your favor before then, you have to wait until the last day to act. Now, let's say you buy an option on Tesla stock. This follows the American style, which means you can exercise it anytime before expiration. If Tesla's stock price jumps early, you don't have to wait. You can lock in your profit right away. This flexibility makes American options more valuable than European options because they give traders more control over when to act. Okay, option exercise value. Let's imagine your option reaches expiration day. How do we figure out what it's worth? If you hold a call option, you only bother exercising if the underlying price sits above your strike price. Mathematically, that payoff is whichever is bigger, 0 or the difference between the underlying price and the strike. So if you had the right to buy a stock at 100 and at expiration the stock is at 110, your payoff is 10. If the stock was at 90 instead, you just walk away from the option and lose only the premium you initially paid. If it's a put option, you compare the strike price to the underlying price at expiration. You'll exercise the put if the asset is below your strike. So your payoff is whichever is greater, 0 or the difference between the strike price and the market price. If your strike was 100 and the market price is 90, that's a $10 payoff. If the market price were 105, you wouldn't exercise the put at all. When you're not yet at maturity, it can be helpful to think of the strike in present value terms. For instance, if you're looking at a call option before its expiration, you could compare the underlying price to the discounted value of the strike price. If the underlying price is higher than that discounted strike, then the option already has some intrinsic worth. Let's go back to our sneaker example. If the Jordans are selling for $300 in stores, but you have a call option to buy them for $250, that option is worth $50. If they're selling for $200, your call option is worth 0 because you just buy them at market price instead. Same goes for puts. If you have the right to sell the sneakers for $250, but they're worth $300, nobody's going to take that deal. But if the price drops to $200, suddenly that put option is worth $50. Easy, right? Now let's talk about the different types of options and when they can be exercised. Let's talk about moneyness. This tells us whether the option stands a good chance of being exercised if we were at expiration right now. An option is in the money if it has positive intrinsic value. A call is in the money when the underlying price is above the strike, and a put is in the money when the underlying price is below the strike. An option is out of the money if it has negative intrinsic value. That happens when a call's underlying price is below the strike or a put's underlying price is above the strike. An option is at the money when the underlying price is exactly equal to the strike. This is that borderline situation where you're just about indifferent. Could be exercised for roughly 0 profit. Now, if you have a call option that's way in the money, say the underlying is at 150 and your strike is 100, You're pretty much guaranteed to exercise. So every dollar move in the underlying translates almost 1-for-1 into your option's value. On the flip side, if you have a put option that's way out of the money, like the strike is 50, but the underlying is sitting at a 100, it might never see the light of exercise day. It has very little sensitivity to price changes unless something dramatic happens. Going back to our Jordans, if the store price is way above your locked-in price, your call option is deep in the money. You're making serious profit. If the price is just a little higher, it's slightly in the money. If it's exactly the same, it's at the money. And if it's lower, your option is worthless, out of the money. All right, let's talk about something that makes options truly fascinating: time value. This is what gives options their potential for profit, even when they're not in the money yet. If you've ever wondered why an option still has value even when its exercise price and market price are the same, time value is the answer. Every option's price is made up of two parts: exercise value plus the time value. The exercise value is what the option is worth if you exercise it right now. It's either positive or zero, never negative. But the time value is where things get interesting. Time value is the extra worth of an option simply because there's still time left before expiration. Why? Because the market is unpredictable, and in that time, the underlying asset's price could swing in your favor. More time means more potential for price movement, which means the option is worth more. Let's think of it in real-world terms. Imagine you have a lottery ticket for a drawing happening tonight. As the clock ticks down, that ticket still holds value because there's a chance you could win. But after the drawing, if your numbers don't match, the ticket is worth exactly zero. Options work the same way. The longer they have until expiration, the more hope, meaning its time value, is built into their price. Here's a handy little formula to keep in mind. An option's price in the market is its exercise value plus its time value. That means if a call option is sitting at an intrinsic value of 5, but it trades in the market for 7, the extra 2 is what we call its time value. This chunk of value reflects the possibility that the underlying price could move favorably for you before expiration. Let's say you have a call option on Apple stock with a strike price of $150, and Apple's stock is trading at exactly $150 today. Technically, this option has no exercise value because buying the stock at $150 when the market price is also the same doesn't give you a profit. But will that option be priced at 0? Nope. Because Apple's stock might jump to 160 or even 170 in the next few weeks. That potential is worth something, and that's why the market will still price your option higher than 0. It has time value. Now, time value isn't permanent. It shrinks as expiration gets closer. Just like that lottery ticket's worth decreases the moment the drawing happens. At expiration, time value is 0. The option is only worth whatever exercise value it has left. The more time left, the higher the time value. Options with longer expiration dates will be more expensive because they hold more uncertainty. At the money, options have the highest time value. This is because they have the most room to move into profitability before expiration. Think of it like a concert ticket. If you try selling a Taylor Swift ticket a month before the show, there's still demand. People are willing to pay a premium because they know the price might rise as the concert date approaches. But if you try selling that same ticket 10 minutes before the show starts, your pricing power is gone. You either sell it for whatever you can get, or it becomes worthless. Same thing with options. Time is money. So let me repeat, the time value naturally erodes as you get closer to expiration. At expiration, that time value is 0, and you're left with purely the intrinsic value, if there is any. The more volatile the underlying is, the greater this time value tends to be, because there's a bigger chance of the underlying's price moving significantly. That also means at-the-money options often carry the highest time value. Since they're on a razor's edge, any nudge in the underlying's price could make them profitable. Arbitrage. Moving on, let's consider arbitrage in the world of options. Arbitrage is basically a way to make a riskless profit if you spot discrepancies in market pricing. For a call buyer, the payoff at expiration is the difference between the underlying price and the strike, if that difference is positive minus whatever premium you paid. For a call seller, it's the same value but with the opposite sign. Similarly, a put buyer can gain if the strike exceeds the underlying's price at expiration, while a put seller would realize the opposite result. There's also the concept of lower and upper bounds for call and put prices. A call can't be worth less than zero. Makes sense. Why would you sell an option for a negative amount? Or less than the difference between the stock price and the discounted strike. Likewise, a put can't be worth less than zero, or the difference between the discounted strike and the stock price, whichever is greater. The upper bound for a call is logically the market price of the underlying itself, since you'd never pay more for the call than simply buying the asset outright. For a put, the maximum is basically the strike price, because you wouldn't pay more for the right to sell an asset than the benefit you'd get if that asset went to zero. Now, this is the heart of the matter. Want to dive deeper into this? Let's go. All right, arbitrage. One of the easiest ways to make risk-free money in the financial markets, if you can spot the opportunity fast enough. If you're aiming to be a CFA charter holder, understanding arbitrage is important because it ensures that option prices stay fair and don't create free money loopholes for traders. In financial markets, arbitrage works the same way. If an option is mispriced, meaning its market value doesn't match its theoretical value, savvy traders can exploit this mismatch and profit without taking on any risk. And trust me, if there is an opportunity, traders will jump on it, which is why arbitrage helps keep prices in check. How do traders profit from options? When you buy or sell options, your profit or loss depends on the price of the underlying asset at expiration. Let's break this down for both call and put options. If you buy a call option, your profit is calculated as the higher value between zero and the difference between the stock price at expiration and the strike price minus the premium you originally paid. In other words, if the stock price ends up higher than the strike price, you make money. If it doesn't, you just lose the premium. If you sell a call option, you're on the opposite side of this trade. Your profit is whatever premium you collected up front. But if the stock price rises above the strike price, you'll be forced to sell at that lower price, leading to a potential loss. For put options, it works in reverse. If you buy a put, you make a profit. If the stock price drops below the strike price, again, the calculation is simply the greater of zero, or the difference between the strike price and the stock price at expiration minus the premium you paid. And if you sell a put option, you're hoping the stock stays above the strike price so that the option expires worthless and you keep the premium. If the stock falls below the strike, you might be forced to buy it at a higher price than it's worth, leading to losses. Now let's talk about the limits on an option's price, how low or high it can go. First, let's look at the lower bound, or the absolute minimum price an option can have. An option can't be worth less than zero. Nobody's going to pay you to take on risk. But more specifically, there's a formula that ensures options are priced fairly. For call options, the lower bound is the greater of 0, or the difference between the stock price today and the present value of the exercise price. This means that the lowest a call option can be worth is either nothing at all, or the amount by which the stock price today exceeds the present value of what you'll have to pay to exercise the option in the future. For put options, the lower bound works similarly, but flipped. The lowest price a put option can have is either 0, or the difference between the present value of the exercise price and today's stock price. This ensures that a put option is never priced too low relative to what it should be worth based on future expectations. Now, on the flip side, let's talk about the upper bound, or the highest possible price for an option. For call options, the most expensive they can get is simply the stock price itself. Why? Because if a call option were ever priced higher than the stock, you just buy the stock directly instead of paying for the option. For put options, the upper bound is the exercise price. Since the maximum value of a put option is realized when the stock price goes to 0, the highest it can be worth is the full amount of the strike price, which is what you'd get if you exercised it under the worst case scenario for the stock. Let's say Tesla stock is trading at $200 and there's a call option available with a strike price of $180 expiring in 1 month. Now, suppose the market is irrational and this call option is trading at $30 when its fair value should be only $25 based on pricing models. A smart trader would immediately sell the overpriced call option at $30 and then buy another identical one for $25 elsewhere, locking in a risk-free $5 profit per option. This kind of arbitrage doesn't last long. The moment traders notice it, they rush in to take advantage of it, and their buying and selling activity quickly pushes the price back to its fair value. This is why option prices stay within their upper and lower bounds. The market corrects itself through arbitrage. Now, let's talk about replication, which is a way for market participants to duplicate an option payoff using more basic building blocks, like borrowing or lending at the risk-free rate and buying or selling the underlying. Imagine you want to replicate a call option. You could borrow some money at the risk-free rate, use that money to buy the underlying, and then at expiration, if the underlying's price is above the strike, sell it off to repay the loan. If the underlying's price is below the strike, you wouldn't exercise your hypothetical call, meaning your losses are capped. This structure essentially mimics the call payoff. So how does replication work? Think of it like this. Instead of buying an expensive designer jacket, you piece together the same look with individual items that cost much less. In finance, we can do something similar with options by combining simple assets like stocks, borrowing, and lending to create the same payoffs as a call or a put. Let's think about this in a real-world way. Say you want to reserve front row seats to a major concert, but instead of buying a ticket up front, you borrow money to secure the seat. If ticket prices skyrocket on resale platforms, you sell your ticket at a higher price and use part of the earnings to repay the borrowed amount. If prices don't increase, you just hold on to the ticket, but you don't lose more than what you originally borrowed. That's basically call option replication in action. You can do a similar trick with a put option by selling the underlying first and then lending the proceeds. At maturity, if the price has dropped, you can buy it cheaply with the loan you made to yourself. If the price is above your strike, you skip exercising altogether. This is a neat illustration of the law of one price. Two instruments that produce the same future cash flows should be priced identically in an efficient market. Imagine you're running a sneaker resale shop. You sell a hot new pair of sneakers for $300, expecting that the price will drop in a few months. Instead of spending that $300, you invest it in a risk-free savings account. If the sneaker price falls to $200 later, you buy them back at the lower price, return them to the original seller, and keep the $100 difference. If the price doesn't drop, you just keep the original $300 and walk away. That's exactly how put option replication works. So why does replication matter? Simple. It keeps the financial markets honest. If an option is overpriced, traders can just build a cheaper version themselves, forcing prices back to fair value. It's also a go-to strategy for investors who want the same payoff as an option without actually buying one, especially when options are expensive or hard to trade. And for portfolio managers, it's a game changer for hedging risk without needing a direct option contract. In short, replication isn't just theory. It's a powerful tool that keeps pricing in check and opens up smarter ways to trade and manage risk. All right, so what actually moves an option's price? It's not just about whether a stock goes up or down. Several key factors play a role, and understanding them will make you a sharper investor. Let's walk through the main variables that shape option pricing with some real-world business examples. First, the value of the underlying asset is the biggest driver. When the asset's price rises, call options generally increase in value, and put options generally lose value. If you hold a call on a stock that goes from 50 to 60, you do a little happy dance. Put holders, meanwhile, might be scowling at least until the next price drop. If you own a call option on Apple stock, and Apple just dropped a game-changing new iPhone that everyone's going crazy over, the stock price will likely shoot up, making your call option way more valuable. On the other hand, if you own a put option on a struggling retailer that just reported awful earnings, the stock price could tank, sending your put option value soaring. Next up is the exercise price. This is what determines whether an option is likely to be in or out of the money. Imagine you're betting on Tesla. A call option with a strike price of $200 will be way more valuable if Tesla is trading at $250 compared to a call with a strike price of $270. Lower strike prices make calls more valuable because you can buy the asset for cheaper if you exercise, while higher strike prices make puts more attractive because you can sell the asset for a higher price if you exercise. Then we have time to expiration, and here's where things get interesting. The longer an option's life, the more time there is for something favorable to happen. That generally pumps up both call and put values, though with puts, especially deep in the money puts, a longer time can occasionally reduce value if interest rates are high. But typically, more time equals a higher option premium. Let's say you buy an option on Netflix before their next earnings announcement. If there's still a month left until expiration, the option has a lot of time value because the stock could move in a big way after earnings. But if expiration is just 1 day away, the time value shrinks fast. That's why longer expiration periods mean higher option prices. More time equals more chances for a big price move. Speaking of time, let's talk about interest rates. Think of it this way. When rates are higher, the discounted value of your strike price is lower, which makes call options more attractive. Conversely, higher rates will hurt the value of puts because the strike discounted back to present terms is smaller. So rising risk-free rates actually increase the value of call options and decrease the value of puts. Why? Because when rates rise, the present value of the strike price falls, making it cheaper in today's terms. Think of it like leasing office space. If borrowing costs go up, locking in a cheaper lease today becomes more valuable. And let's not forget volatility, the wild card of the market. Higher volatility makes both calls and puts more valuable because the greater the price swings, the higher the chance of a profitable move before expiration. Picture a stock like GameStop or AMC during the meme stock craze. Prices were swinging wildly, so their options were insanely expensive. The more unpredictable a stock is, the higher its option prices will be. Lastly, income and costs related to the underlying play a role too. If a stock pays dividends, it's bad news for call options because option holders don't get dividends. But it's great for put options since a stock price typically drops by the dividend amount on the ex-dividend date. On the flip side, if the asset has carrying costs, like oil storage or financing fees for holding physical gold, it actually makes call options more valuable and puts less attractive. So, I repeat, if the underlying pays dividends or has benefits of ownership, then call holders miss out on those benefits, which can drag down the call's price. Puts, on the other hand, can become more appealing. Conversely, if there are storage costs or other expenses tied to holding the underlying, calls get a boost and puts might lose some luster. Bottom line, options aren't just about stock prices. They react to multiple moving parts. Understanding these factors will help you predict how options move and make better trading or hedging decisions. So next time you're looking at an option, don't just check the stock price. Think about the bigger picture. In short, keep your eyes on all these levers when you're analyzing options. Each has its own distinct impact on how that price tag is ultimately determined. And that, folks, is your grand tour of option pricing and valuation. We've journeyed from the basic definitions through exercise value and moneyness, all the way to replication and the myriad factors that shift an option's worth. I hope this approach helps these concepts stick. Whenever you need to review or prep for your exam, make sure to hit up FinQuiz's Stanley Notes, mock exams, and battle-ready summaries. They're tried and true resources that break down these ideas efficiently and give you just the right amount of practice to build your confidence. Keep up the great work. And remember, the more you engage with these concepts in a practical, hands-on way, like imagining real trades, real payoffs, the more they'll become second nature. Thanks for hanging out with me today, and I'll catch you in the next session. Until then, happy studying and good luck on your CFA journey.